thought leadership from PwC.
Welcome to PwC's Accounting Podcast. I'm Heather Horn. Thanks for tuning in to the next episode of our Toolkit series, where we're taking a deep dive each month into a single topic, recapping the basics, but also focusing in on frequently asked questions and judgmental areas. For the month of March, it's all about revenue recognition. This week, it's step 4 of the revenue model, allocating the transaction price.
There's lots of guidance to follow here, and you can get a little bit lost in the numbers and the mechanics, and you can't forget to then step back, look at the allocation. Does it make sense?
What I would suggest is when companies have to estimate SSP, they consider leveraging an existing process.
Angela Fergason, a PwC National Office Partner, is, of course, back with me again, and she's brought with her a familiar voice, PwC National Office Partner Mike Coleman, who you may remember from the second episode in this series. To give a quick recap, so far over the past 3 weeks, we've identified the contract, identified the performance obligations, and determined the transaction price. We're now at step 4, where we'll allocate the transaction price, which is an exciting milestone because it's the last step before we get to actually recognize revenue. We're almost there. Mike, Angela, welcome back to our 4th step in the 5-step revenue recognition model. So getting close to done. And this week, we're going to be talking about allocating the transaction price. And we'll be running through the accounting guidance in the area, including those topics where we get the most questions, or always like to talk about the areas of judgment. So with all of that background, Angela, can you just remind our listeners of sort of where we are in these 5 steps?
Sure thing. So we started out with step 1, which is when we identified the contract with the customer. Then in step 2, we identified the performance obligations in that contract. Last week, when we covered step 3, we talked about determining the transaction price. Now in step 4, we're going to allocate that transaction price to each of the performance obligations that we identified in step 2.
So Angela, before you go on to tell us the objective in step 4, since we're almost to the end, can you tell people what step 5 is so they know what to look forward to?
We'll finally be recognizing revenue.
All right. Next week. They better tune in next week. Okay. So with that to look forward to, let's stick to this week. So what is sort of the key objective of step 4?
So step 4 has a stated objective that we're going to allocate the transaction price to each performance obligation in an amount that depicts the amount of consideration to which the entity expects to be entitled to for transferring the promised goods or services to the customer. So you could tell I was reading that.
Yes.
But in general, the way we're going to achieve that objective is by allocating the transaction price to each performance obligation based on relative standalone selling price, or as we like to call it, SSP.
All right, get the lingo down.
So SSP is going to be a big part of step 4. Importantly, this allocation, it happens at contract inception. So after you allocate the transaction price at contract inception, you do not reallocate later on, even if there are changes in SSP. There are also some special considerations when you're allocating discounts and variable consideration. So we will also hit on that during this podcast.
All right. Well, definitely seems like the key place to start is SSP, or standalone selling price. So how is that determined?
So as the name would suggest, the best evidence of SSP is the price that a company would charge for that good or service when it's sold separately or sold on a standalone basis to similar customers in similar circumstances. So a couple of things to note here is that you cannot assume that the price stated in the contract is SSP when it's being bundled with other things. So what we're focusing on here is what is the price when a good or service is sold on its own. Additionally, list price is not automatically SSP, because companies will often give discounts or a practice of providing price concessions or adjustments to list prices. So you have to take all of that into account. And then lastly, it's not unusual to have situations where a good or service is not sold on its own. A company is always bundling it with something else. So that is where we have judgment in this area, and the company has to estimate the standalone selling price.
All right. So then, Mike, bringing you into the conversation, what are some of the common approaches that you see where, when a company has to estimate this SSP?
Sure. So the revenue standard doesn't prescribe or prohibit any particular method for estimating SSP, as long as the method results in an estimate that faithfully represents the price an entity would charge for the goods or services if they were sold separately. So it's important to note the company should maximize the use of observable inputs into the estimate. And the standard does discuss 3 possible methods that may be used. Those 3 are the adjusted market assessment approach, which is basically considering pricing for similar goods or services in the market, whether it's the company selling them or those sold by competitors. The second one that's mentioned is the cost plus margin approach. So you determine the costs to fulfill the performance obligation plus some reasonable profit margin. And then the last one is a residual approach that's allowed in limited circumstances.
I have 2 questions. So the first one, is there any, I know you said there's 3 possible methods and, it doesn't specify. Is there any sort of preference among those, or do you use the best in the circumstances?
No, I don't. The standard doesn't have a preference. It's what makes the most sense to come up with a price that you'd estimate if you were selling that price by itself. So there's no hierarchy or ordering.
All right. And then I assume, like many places in GAAP, that we would expect people to use similar approach to similar contracts, or does it really depend facts and circumstances of an individual contract?
I think it's probably more the particular good or service that you're estimating more than the contract itself. The contract, you get into the customer grouping, right? So that may impact into it. But it's more, if I've got one product and I'm establishing the price for that one product, I should be consistent when I sell that same product to others. And
yes, that makes sense. Standalone
right.
Selling price would not change likely.
Right.
So
Right.
I guess, again, depending. But so from that to that point, then, what are some of the considerations when you're estimating that SSP?
Yeah, so as much as you want to take that consistent type of approach, you can have a different SSP for the same product depending upon the type of customer you're selling it to. So if you've got large volume customers versus small volume customers, or if I sell the product to resellers or end users or OEMs, I may have a different pricing strategy for those types of customers, geographies, industries, etc. Again, the goal is, if you sold that separately, what would your selling price be? And a lot of times, who the customer is or the type of customer would indicate a different price.
So, as always, we're going to have a little vocabulary lesson here. So OEM, for the listeners that may not recognize that term.
Original equipment manufacturer.
Oh, that was my guess. I should have said it. Okay.
Sorry, and the other thing to keep in mind, Heather, is when establishing the price, it can be a range, right? It doesn't need to be one price for your product group, because oftentimes you negotiate different prices with different customers. So it doesn't have to be a single point. It can be a range.
All right. And then my guess is, based on all the rest of our conversation, is that there's no specific guidance in terms of how big a range you can use.
No, no, there isn't. So there's no bright lines on how big the range is. Now, having said that, if there's a wide range, the company should probably decide if they should stratify that population or that pricing to different customers to see if the pricing that they've estimated is correct, and maybe there should be 2 ranges instead of one very wide range. You also want to be consistent of how you apply the range. So we said, okay, well, what does that mean? Well, let's say you establish your SSP as a range, and then in a contract, you have a product where the price falls outside of the range. Well, the reallocation, are you allocating to the end of the range, to the middle of the range? So the question is, you should probably be consistent and have a policy for what you do for those things outside of the range. And then, sometimes instead of coming up with that price, even though it's in a range, you may also be appropriate to consider SSP as a percentage or of some type of value relationship. So, for example, if I'm a software vendor that bundles certain software licenses with PCS, and I don't sell the software licenses on a standalone basis, it may be reasonable to conclude that there's a value relationship between the license and the PCS that could be used to establish SSP if the vendor has historically and consistently priced PCS as a percentage of the license fee for both the initial purchase and the renewals for other types of software. So, for example, let's say a vendor may determine that for certain of its software, PCS is historically and consistently priced at 20% of the license fee. And so they want to use that amount, which would be considered an observable input, something we have to maximize in the process. And we use that relationship, the 20% of the license fee, as an input into trying to figure out what the SSP should be for the cases where we don't sell the software and PCS separately.
All right. And then one more term. So PCS?
Post-customer contract support. I know I said four things. The post-customer has a hyphen.
All right.
So the P is post-customer. The C
Got
is
it.
contract. And that's the support.
Oh, yeah, that's a good point, because otherwise it would be PCCS.
Yeah,
All right. So that's good. We're learning a lot of new things here. So, okay. So then let me ask another follow-up question. And Angela, I'll go back to you for this one. So Mike, when he was listing these possible approaches, did mention a residual approach, but said that would be limited circumstances. So can you provide some greater context on that?
Yeah, well, first I'll explain what we mean by residual approach. So residual approach is when you start with the total transaction price and then subtract from that the SSP for goods or services where you have an observable SSP. And then what you have left, or the residual, gets allocated to the remaining item, or could be more than one item. So the use of this residual approach to estimate SSP is only permitted when you meet certain criteria. So the criteria are either, one, the price is highly variable. So that means you have a good or service that you sell for a broad range of prices, or the price of the good or service is uncertain, which means the company hasn't yet established a price because it hasn't sold the good or service before. So typically when we're talking about residual approach, it's when a good or service is being sold for a broad range of prices, or you're in that highly variable category. But the circumstances where you can use the residual approach are meant to be limited. So you should consider whether there's another method that provides a reasonable estimate of SSP before you go to the residual approach. And this goes back to what Mike talked about when he was saying you need to maximize the use of observable data.
So then, Mike, from your experience, when do you often see this residual approach being used? Because it does sound pretty limited when you'd be able to.
Yeah, it's typically for intangibles, and we see it a lot in software as a type of intangible for it. And this is generally because other methods just may not be relevant or practical to apply. So, for example, like the cost plus margin approach sometimes is difficult. So for equipment, it's easier to determine the direct and indirect costs of that piece of equipment to then apply your margin to. Sometimes software, it's not so easy to figure out what those direct costs are and how to apply exactly a cost plus margin approach. So we typically see it for software. The other important reminder is when you do apply the approach, you've got to step back and assess, are we meeting the objective? Are these results reasonable? Is this really what I would sell that piece of software for, or that license, or whatever I'm using the residual method for?
But if you've gone through sort of your hierarchy here and you've applied that, what do you mean by saying, okay, is this reasonable?
Sure. Let me give you an example. So let's say we go through that step and we say, oh, this is a great candidate for the residual method. And we apply the residual method and the result is 0.
Mm.
So the price of the software is 0. Okay, that's not a price. So I know that's extreme, but it can happen given the wide variability of the software, which is one of the reasons you'd apply this method. But you still have to meet the objective. So if it comes up with a number that makes 0 sense and that would never be what you would sell the item for separately, then back to the drawing board, you got to come up with something else. It can't be the residual method.
So then is it fair to say this is more of an art than a science when you're calculating the SSP?
It is, but that art requires a lot of analysis to support and a lot of data.
All right, so make sure you have some good spreadsheets.
Supported by a lot of data and analysis.
Yeah, make sure you have some spreadsheets for your art. So, all right, that's helpful. So then let me switch gears again. And Angela, you mentioned early on that there's some special considerations for allocating discounts and variable considerations. So didn't want to skip over that comment. Can you kind of walk through what we should be thinking about there?
Yeah, and to go back to the general model again, generally you're going to allocate transaction price based on relative standalone selling price. So that means even if you have discounts or variable consideration in a contract, you're generally going to allocate those items across all of the performance obligations in the contract. However, there are certain situations where a discount or variable consideration would be allocated only to one or more, but not all of the performance obligations in the contract. So if we start with discounts, I'd say, first of all, it's not that common to meet the criteria to allocate a discount to only one performance obligation. But it is possible. So to explain this through an example, assume you have a contract to sell a piece of equipment along with installation services and professional services, and that all 3 of those things are distinct. So you have 3 performance obligations in the contract. And now let's assume that overall there's a 20% discount in this contract as compared to the SSP for those 3 items. So generally, you would allocate that 20% discount proportionately across the 3 performance obligations. But if the company regularly sells each of these items on a standalone basis and regularly sells the equipment and installation, for example, at a 20% discount, then you would allocate the discount only to the equipment and installation and not to the professional services. So, there are these factors or these criteria, if you meet them, that would indicate that the discount clearly relates to only part of the contract and not to the entire contract. But I would say this is a fairly high bar to meet, and so we don't see it that often. Usually discounts are going to end up being allocated across the whole contract.
Heather, it would be one of those scenarios where you need a lot of spreadsheets and data.
And data to support. All right. So, Angela, I think that's helpful. Now, let's get on to something that I think we've mentioned at least one of our other podcasts, if not more than one, and that would be allocating variable consideration. So, what are some of the things we should be thinking about there?
Yeah, this is a topic that does come up quite often. And again, under the general model, as we've talked about, variable consideration is estimated and included in the transaction price, in step 3. And then in allocation, we would allocate that to all the performance obligations based on relative standalone selling price. However, there is some special guidance where variable consideration would be allocated to a specific performance obligation or to a distinct good or service within a series if certain criteria are met. And these are that the terms of the variable payment relate specifically to the company's efforts to satisfy the performance obligation or transfer that distinct good or service, and allocating the variable amount of consideration entirely to that element is consistent with the allocation objective. So going back to my last example, the equipment installation services and professional services, assume that this company is going to get a performance bonus, which is a type of variable consideration, if the equipment is installed by a certain date. So in this case, the terms of this bonus or the variable fee or variable consideration relates specifically to the company's efforts to complete the installation services. And so this is a situation where you may end up concluding that that bonus should be allocated entirely to the installation services rather than being spread across all the performance obligations in the contract.
So, Angela, if I think about your two criteria, the first one makes a lot of sense to me, especially in your example. So I'm getting this bonus because I installed the equipment. So I'm in the relate by a certain date. So I'm going to associate the bonus to the installation. Totally makes sense. But your second criteria was that allocating the variable amount entirely to that element is consistent with the allocation objective. So what do we mean when we say consistent with the allocation objective?
Well, you'll remember at the very beginning, I gave that textbook objective, right? That was we're going to allocate transaction price in an amount that depicts the amount of consideration to which the entity expects to be entitled to for transferring the promised goods or services to the customer. But what does that really mean? Well, that means that when you step back and look at the big picture, once you've allocated the transaction price, does this end result make sense? So, for example, in my simple illustration, if the amount of that bonus was disproportionately large compared to the fee that the vendor was charging for the other items in the contract, then it may not make sense to allocate all of that bonus to the installation services. In other words, there may be some sort of structuring going on here with the pricing that doesn't really reflect the value of the individual items that are being provided. So, generally, where you should end up is that big picture, the amount allocated to each performance obligation should be consistent with relative standalone selling price. But it isn't going to necessarily be an exact science.
All right, back to the spreadsheets that Mike needs to support his art in this conversation. So then, Mike, with that point, where do you often see this allocation question come up in practice?
Yeah, I would say a common situation is when we're providing a service that's a series of distinct services. So if you recall, Angela talked about series during the Step 2 podcast. Angela used bookkeeping as the series, as the example. I'm not going to use bookkeeping. I'm going to use a different example. So I'm going to take, let's say we had a series that's a contract to provide transaction processing services, where the companies promise to process all the transactions for a stated period of time. And then the company concluded each month is a distinct period of services within that series. And the contract has a variable fee for each transaction processed during the month. So a P times Q, as it were, for the transactions processed during that month. So by applying the guidance Angela outlined, you would likely conclude the variable fee occurred in each month should be allocated to that month's performance. And then each month's variable fee relates specifically to the company's effort for that month, assuming the fee per transaction is consistent throughout. There's no underlying like volume discounts, et cetera.
So, Mike, is there a scenario when you wouldn't conclude that or no?
Well, there are scenarios where you wouldn't conclude it, but you wouldn't want to be in those scenarios, right? You really want to be in the series guidance, because if you concluded you weren't and you concluded the variable consideration relates to everything in the contract, now take your transaction processing example. You'd have to estimate all the transactions processed during the period of time and then allocate all that estimate of variable consideration to all of those transactions processed. And then you'd have to true it up every month. It would be challenging is a word. Others would say it would be a nightmare to try to apply to do that. So that's the important distinction we give to the series guidance in that case for variable consideration. But there are cases where you are left with doing that. And that would be, well, let's say I've got a contract for a year and the first 6 months is a fixed fee and then the next 6 months is a variable fee. It's like, okay, now I don't have one measure of fee. It's not every same formula for every distinct month in the series, and you might be left with saying, well, that's not something I can allocate to each month, and I've got to move out of that and estimate. So it does happen. You don't want it to happen.
Well, and I guess that goes back, Angela, to your point, and maybe they don't use the same words, but your overall allocation objective doesn't seem like it would be met if I just followed the contract in Mike's example of the 6 months and 6 months.
Right. And another example would be like if the fee per transaction was significantly different in different periods and there wasn't a good reason or, a reason that was consistent with the economics of why that fee was changing. And then you'd say, well, having a very low fee in one period per transaction and a very high fee per transaction in a different period would not make sense or meet the allocation objective.
So Mike, Angela, definitely a lot to think about here. As you sort of reflect on the overall model, what would be your key takeaway for this particular step? Angela, I'll go to you first.
Well, I think it's part of what we just talked about in that last topic, which is the importance of stepping back and looking at the big picture. So, there's lots of guidance to follow here, and you can get a little bit lost in the numbers and the mechanics. And you can't forget to then step back, look at the allocation. Does it make sense? Is it consistent with what we're trying to achieve, the objective of this step? Like, you can't forget to have that final analysis of the big picture.
All right, sanity check. And Mike, how about from your perspective?
Yeah, what I would suggest is when companies have to estimate SSP, they consider leveraging an existing process. So, for example, if a company has a pricing process that's established, consider leveraging that as the way you create SSP instead of creating an entirely new estimate that the company's not familiar with.
Definitely good advice there. Especially, I think your auditors would appreciate that advice as well. So, all right. Well, Mike, Angela, as always, definitely learned a lot today. Thank you so much for all your insight. Before we wrap up, though, two more things. So first of all, Angela, where would our listeners go for more information?
Yeah, we cover step 4 of the model, allocating transaction price, in chapter 5 of our revenue guide, Revenue from Contracts with Customers Guide.
And then, of course, we're up to my favorite part of the podcast, Stump the Guest. Now, I think when I had the two of you on a few weeks ago, I think you got 50%. So let's see if you guys can get up to 100% correct today, although these are interesting questions. So question number 1, So as you both would know, for many years, when companies were allocating the transaction price in software arrangements, they were beholden to the stringent standard of VSOE, or vendor-specific objective evidence of fair value. What guidance introduced the concept of VSOE, and more importantly, so we'll do this in two parts. This is still all one question.
SOP 97 too.
All right, so you knew the first part. So, and you already you kind of got, this is going to give you a clue for my next question.
SOP 98.9.
No. This is now moving on to literature. So the first book of what major international best-selling book series was also published the same year as that guidance. So we know it's 97, although maybe that was published in 98 by the time it was published. But what best-selling book series first book was published the same year? I actually have a guess for
maybe
this
like
one.
Harry Potter or something.
Harry Potter.
Is that the right time?
Yeah, that was going to be my guess too. It's got to be. What other like major international? So, fact check. Mike got the first part right with his answer of the AICPA's SOP 97.2, and he was right again, along with Angela, on the second part of the question. The Harry Potter and the Philosopher's Stone was released in the UK in 1997, then released in the US in 1998 as Harry Potter and the Sorcerer's Stone. So then continuing, so far you're going to get at least 2 out of 3. So continuing with our theme of superseded guidance, EITF 0801 introduced what concept is the third choice in the hierarchy of determining fair value of deliverables in a multi-element arrangement following VSOE and TPE. Maybe you can tell us what TPE is first.
Third-party evidence, wasn't it, Mike?
Right. It introduced SSP.
All right.
I think 0801 introduced SSP. That would be my guess.
I will check the answer on that one. Fact check. Angela, nice work on telling us what TPE stands for. A bonus point for you. But the correct answer for the true question is the concept introduced was ESP, or estimated selling price. Angela and Mike, as I said, as always, such a pleasure to have you on. Thanks so much for joining me today. That's our show for today. Join me back here next Tuesday for the final episode in our 5-part revenue recognition series. And I'll also be announcing April's topic of the month. It's a newer area where we can continue to see a rise in questions, and my team and I are excited to tell you what we have planned for April. But before then, we have 2 more news shows for you this week. On Thursday, we're covering the SEC cyber proposal, and on Friday, it's a bonus episode looking at the SEC's climate proposal. 2 timely, hot off the presses shows you won't want to miss. And look for some special programming the following week covering the accounting and business implications of the Russian government invasion of Ukraine. So that you never miss any of our audio content, follow the PwC Accounting Podcast series wherever you listen to podcasts. From Thought Leadership at PwC, I'm Heather Horn. Thanks for tuning in.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and they sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.